Hey everyone, welcome to a deep dive, into a true investing classic.
Oh, yeah.
Benjamin Graham's The Intelligent Investor. Now, this book is practically, it's legendary in the world of finance.
Yeah, for sure. It's definitely stood the test of time.
Yeah.
Still offers, insights that are as relevant today as they were decades ago.
Exactly. And that's what, our mission is today, is to try to break down some of Graham's, core teachings and help you, the listener, grasp those essential principles for becoming a more intelligent investor.
Right. Yeah. And I think that starts with, really understanding what intelligent investing even means.
Okay.
Graham, he didn't believe it was about having a genius IQ or anything. It was more about your temperament as an investor.
Okay. Temperament over smarts.
Yeah.
What did he mean by that?
So he highlighted qualities like patience, discipline, being eager to learn, and then crucially, this is so important, being in control of your emotion. He actually has this famous quote. He said, "The investor's chief problem and even his worst enemy is likely to be himself."
Wow.
Yeah.
That's powerful.
It is.
So it's not about being like some, prodigy when it comes to finance, but about mastering your own mind.
Exactly. Yeah. Yeah. And before we even get into specific strategies, I think it's super important to understand this distinction that Graham draws between investing and speculation.
Okay.
Yeah.
Now, I have a feeling, he wasn't a big fan of just picking stocks randomly and just hoping for the best.
You're right on. He definitely wasn't.
Okay.
He saw speculation as basically, gambling.
Okay.
It's relying on chance instead of having this calculated approach.
Okay.
But, he did acknowledge that, some people might be tempted to dabble, a little bit.
So he wasn't completely against taking a little risk now and then.
Not exactly, no.
Okay.
He advised, that if you are going to speculate, set aside a very small portion of your capital for that.
Okay.
But never throw good money after bad. So, the key was never throw more money in just because it's going up.
Yeah.
Discipline is key.
I can imagine that takes serious willpower to, not get caught up in that.
Yeah.
Speaking of discipline.
Yeah.
Graham had this brilliant way of describing the stock market, right?
Yeah.
He called it Mr. Market.
Yeah, Mr. Market. Right. So picture Mr. Market as this, unpredictable character who shows up every day offering to buy or sell you stocks at, a certain price.
Okay.
But the catch is he's really moody.
Oh, okay.
Sometimes wildly optimistic, sometimes super gloomy.
Got it.
And the prices that he offers often reflect his emotions, more than the actual value of the business.
Interesting.
Yeah.
So how should, an intelligent investor handle this erratic Mr. Market?
Yeah. The key is to not let his mood swings control your decisions. An intelligent investor can see that those prices are often irrational and uses these ups and downs to their advantage.
Okay, so buy low.
Buy low, sell high. That makes sense.
Sell high, exactly.
But doesn't that require, timing the market perfectly, which most people can't do?
Not that true. Instantly, you hit on a key point. Yeah, Graham was very skeptical about anyone's ability to time the market consistently.
Okay.
He even pointed to studies showing that, even professional market timing newsletters underperform a simple index fund.
Ouch. So all that, fancy forecasting isn't as helpful as some gurus claim it to be.
It might make you feel good.
Okay. Okay, yeah.
And I think, this leads to a really, important point. According to Graham, intelligent investing isn't really about predicting the future.
It's more about analyzing the present, understanding a company's worth, and then buying when Mr. Market is being irrational and offering a discount.
So it's more about finding those hidden gems that are undervalued rather than trying to, predict what's going to happen in the future.
Exactly. Yeah. Yeah. And that leads us to another really important principle.
Okay.
Diversification.
Oh, diversification.
Yeah.
Yeah. I've always heard that saying, don't put all your eggs in one basket.
Exactly. Yep. Yeah.
When it comes to investing.
And Graham, he acknowledged that some people have made fortunes by concentrating their investments.
Yeah.
But he really stressed that takes, a rare level of skill and insight that most people just don't have.
Okay. Yeah, that makes sense.
Yeah.
So what's a more, I guess, realistic approach to diversification for someone who isn't, Warren Buffett.
Right.
Like, what would you recommend?
So Graham actually suggested this really simple formula, 50-50, keeping a rough balance between stocks and bonds
Okay, so stocks and bonds 50-50.
in your portfolio. Yeah.
Okay, that seems manageable.
Yeah.
But, how should someone who considers themselves, like a defensive investor,
Right.
someone who's not,
Yeah.
glued to the stock market all the time,
Yeah.
how should they, go about choosing
Right.
which stocks to buy?
Well, this is where it gets, interesting because Graham actually debunks a common myth that I think is still around today.
Okay.
This idea of buying what,
Wait, so what's wrong with that?
well,
Isn't it good to invest in companies you understand?
I mean, it sounds intuitive, right?
Yeah.
But familiarity does not equal a good investment.
Okay.
Yeah, he gives this great example with this company called AAA Enterprises.
Oh, okay. What happened to AAA Enterprises?
So the company went public at $14 per share.
Okay.
People might have felt good about investing in it just because the name sounds familiar,
Yeah?
even trustworthy.
Yeah.
But the stock ended up plummeting to 25 cents.
Oh, wow. Okay,
Yeah.
that's a cautionary tale.
Yeah, huge cautionary tale.
So, if buying what you know isn't the best strategy,
Right.
what did Graham recommend for the defensive investor?
So he suggested, focusing on large, well-established companies
Okay.
that are currently
Yeah.
out of favor with the market.
Out of favor.
Yeah.
That doesn't sound very appealing. Why would you want to invest in companies that aren't popular?
Right. Yeah, because that's often where you find good value.
Oh, okay.
Right. They might be temporarily unpopular
Yeah.
for reasons that don't actually reflect fundamental problems with their business.
Okay,
Yeah.
so it's like finding a diamond in the rough, or
It's like finding those gems
Yeah.
that are on sale
yeah.
because the market is misjudging them.
Okay, that makes
Yeah.
sense.
Yeah.
So
Think about, for example,
Yeah.
the railroad industry. Okay.
After the Penn Central Transportation Company collapsed
Mm-hmm. Yeah.
in the 1970s.
Yeah.
that was a huge bankruptcy.
Yeah, I remember learning about that.
Yeah.
Yeah.
It shook the whole financial world.
Yeah.
And it made the entire railroad industry unpopular.
Oh.
Even though many of those companies
Right.
were still fundamentally sound.
So an intelligent investor would have seen that as an opportunity to
Buy low.
buy those. Yeah.
Yeah.
Solid railroad stocks at
At a bargain.
a bargain. Yeah.
Yeah.
Okay, but Graham also warned about falling for what he called per share earnings traps.
Oh, so this is where things get a little
Yeah.
tricky, right?
Yeah.
What kind of traps should investors be watching out for?
So one of the biggest red flags is creative accounting,
Oh, yeah.
like tactics that can distort
Okay.
companies' real earnings
Yeah, I've heard about, companies kind of playing games with their numbers.
all the time.
What are some examples of those accounting tricks?
So one common tactic is to report what are called pro forma earnings,
Okay.
which basically exclude certain expenses
Okay.
to make the numbers look better.
So it's kind of like saying, look how profitable we'd be if we didn't have to pay for all these things.
Exactly. It's
Yeah.
exactly what they're doing.
Yeah.
Yep. Another trick is aggressive revenue recognition,
Okay.
where companies book revenue before they've actually earned it.
Oh, wow.
There's a classic example of this.
Yeah.
It's the case of Quest,
Okay.
this telecom company that overstated its revenues by $2.2 billion.
Wow. That's not just bending the rules. That's breaking the rules.
Massive scandal.
Wow.
And then you have things like, pension fund manipulations where companies make these unrealistic assumptions
Yeah.
to inflate their earnings.
Okay, so it's like an intelligent investor
Yeah,
needs to be a bit of a detective,
exactly.
really digging into the financial statements to make sure
Yeah.
these earnings are legit.
Yeah, you got to be skeptical.
Yeah.
And that's where one of Graham's most important concepts comes in. The margin of safety.
Okay, now we're getting to the good stuff.
Yeah, the good stuff.
I've heard this term before, but can you explain what margin of safety means?
Yeah, so it's the idea that you should never pay full price for even the best company.
Okay.
Always buy at a discount to account for the unknowns,
Okay.
the potential risks.
Okay, so it's kind of like having this built-in cushion
Exactly.
to protect you if things don't go as planned.
Yeah. Think about buying a used car.
Okay.
You wouldn't pay the same price as a brand new car.
Yeah.
Right.
Yeah.
You want a discount.
Yeah.
because of the wear and tear, the potential problems.
Yeah. There's always a chance things aren't as perfect as they seem.
Exactly.
Yeah.
And same applies to investing.
Yeah.
Even with like thorough analyses, there are always unknowns. So that's why Graham insisted on that margin of safety.
Okay, I see how this all fits together.
Yeah.
So how would like an investor like actually go about finding that margin of safety?
So one classic example that Graham gives is buying a stock
Okay.
below its net current asset value.
Okay.
Basically, you're paying less
Yeah.
for the company
Okay.
than what its liquid assets are worth.
Oh, that sounds pretty safe.
Yeah, it can be. But remember,
Okay.
even with a margin of safety,
Yeah.
intelligent investing is a long game.
Right. Yeah. It's not about getting rich quick,
Exactly.
but building wealth steadily over time.
Yep, you got it.
And that brings us to another important point,
Yeah,
this long-term perspective.
exactly. Yeah, intelligent investing is a marathon, not a sprint.
Right.
It requires patience, discipline, and the ability to ride out the inevitable ups and downs of the market.
So no panicking
No,
and selling everything when Mr. Market throws a tantrum.
no, exactly.
Right.
Yeah, Graham believed that by focusing on the fundamentals of a business, buying with a margin of safety, and holding for the long term,
Yeah.
investors can weather any storm
Yeah.
and come out ahead.
Yeah, I'm definitely like seeing the wisdom in his approach.
Yeah.
But how do those principles apply today?
Yeah.
You know, with all the high-speed trading and all this constant news and everything.
Yeah. Yeah.
Are his ideas still relevant?
That's a great question, and it's one that I think we'll explore
Okay.
further as we continue this deep dive.
Okay.
But, even in today's, crazy,
Yeah.
fast-paced markets,
Yep.
those core principles
Yeah.
of intelligent investing
Yeah.
remain incredibly relevant.
Okay, awesome.
Yeah.
I'm already feeling, more confident and knowledgeable just from these initial insights.
It's-
And there's more to come.
Oh, yeah, lots more to come.
Stay tuned, everyone. In part 2 of our deep dive into, the intelligent investor, we'll explore even more of Graham's, powerful insights and help you build a stronger,
Yeah.
more resilient portfolio.
For sure.
All right.
Absolutely.
Welcome back to our deep dive into the intelligent investor. I mean, we've laid out those core principles, like temperament,
Right.
Mr. Market, margin of safety.
Totally.
But now it's time to get into, the specifics.
Yeah, let's get into it.
Like, how do you actually,
Yeah.
put these ideas into practice to build a smarter portfolio?
Right. So one of the most interesting parts of the book, I think, is where Graham talks about bond funds
Okay.
and how they fit into a defensive investor strategy.
Okay, bond funds. To be honest, that doesn't sound as exciting as, picking individual stocks.
You might be surprised.
Yeah.
Graham actually saw bond funds as a really valuable tool,
Okay.
especially when interest rates are high.
Okay, so why the emphasis on bond funds?
Yeah.
Particularly when interest rates are high.
Yeah. So back when Graham was writing,
So,
bond investors basically had two main choices:
okay.
taxable or tax-free bonds,
Okay.
and then short-term or long-term maturities.
Okay.
He really favored U.S. savings bonds.
Okay.
Considered them the most sensible option for a long time.
But weren't there some downsides to just sticking with
Totally.
savings bonds?
Yeah.
Didn't they have pretty low returns compared to,
Well, that's true.
other investments?
They did, but Graham, emphasized that their safety
Yeah.
and their other perks. For example, the option to get your money back
Okay.
outweighed those lower returns, especially for that defensive investor.
Interesting. So where do bond funds
Yeah.
come into this, and why did Graham see them as this good alternative?
Yeah, so bond funds offer diversification. You've got professional management,
Okay.
and they can be more tax efficient, particularly if you're investing outside of a retirement account.
Right. Those are definitely
Yeah.
pluses. But
Yeah.
how does this all connect to interest rates being high?
Right. So when interest rates are high,
Yeah.
bond prices tend to be lower.
Okay.
And that can create some great buying opportunities if,
Okay.
looking for income and stability.
Okay.
Bond funds let you take advantage of this without having to pick and choose
Yeah.
individual bonds.
Okay. So investing in, a diversified bond fund when interest rates are up is kind of like locking in those higher yields,
Exactly.
over the long haul.
Over the long haul, that's it. Yep.
That makes sense.
It's a smart way for defensive investors to kind of build that solid foundation for their portfolio.
Okay. Yeah, that makes sense.
Yeah.
Now, shifting back to stocks,
Yeah.
I know Graham had some specific criteria
Yeah, he did.
for choosing those, unpopular large companies we talked about. Can you walk us through his thinking there?
Yeah, absolutely. There's this whole chapter called A Comparison of Four Listed Companies, where Graham basically dissects the financials and performance of four real companies
Wow. Okay.
that were listed on the New York Stock Exchange.
So he was basically giving his readers this
exactly.
real world case study.
Exactly, a real world example of how to analyze potential investment.
That's really cool. What were some of the
Yeah.
key things he looked at in that chapter?
All right, so he zeroed in on things like the company's earnings record
Okay.
over the long term,
Okay.
how strong their finances were,
Okay.
their history of paying dividends,
Okay.
and of course the price of the stock
Right.
compared to those fundamental factors.
Okay. Those sound like, the essential ingredients for any smart,
Yeah,
stock analysis.
absolutely.
Now, did he just look at the most recent data?
Not at all. He even analyzed the price history of those companies going back decades.
Wow. Okay.
Yeah, he wanted to see how their stock prices had moved over time.
Okay.
Yeah.
That historical perspective must have been super valuable, to kind of get a sense of
Yeah,
how the market had valued these companies in
exactly.
different economic situations and stuff.
Exactly. It helped him see when the market had overvalued or undervalued these companies.
Okay.
Basically pointing out those moments when an intelligent investor
Yeah.
could have made a really good move.
So it's all about, spotting those times when Mr. Market's being irrational
Yeah.
and
right.
creating those opportunities to buy low
That's it.
and sell high.
Yeah.
Speaking of, Mr. Market,
Yeah.
didn't Graham also have this whole
Yeah.
your concept about
market's folly.
Yeah. What was that all about?
So he believed that because Mr. Market is so emotional,
Right.
his ups and downs
Yeah.
often create these price swings that have little to do
Yeah.
with the real value of the business.
So those times when fear or greed takes over and everyone's just
Yep.
rushing to buy or sell
Yeah.
without thinking.
Without thinking it through.
Yeah.
Yeah, exactly.
Yeah. And Graham saw those irrational swings
Yes.
as a chance for the intelligent investor to profit.
Sure.
Yeah.
Exactly.
So how can investors avoid getting caught up
Yeah.
in Mr. Market's folly and making those emotional?
So by doing their own independent research,
Okay.
right, focusing on the long-term potential and financial health of the company,
Okay.
and then refusing to follow the crowd.
Yeah.
Just because everyone else is doing it.
Right. It's about having the courage to go against the tide, especially when everyone else is panicking or getting overly excited.
Exactly. And this is where Graham's idea of a margin of safety is so critical.
Ah, yes, that buffer
That buffer.
to protect us from Mr. Market's.
Basically having a financial shock absorber
Yeah.
for your portfolio
Yeah.
to help you kind of stay the course when things get a little bumpy.
I like that. Yeah.
Yeah.
But I have to ask, even with the best research,
Yeah.
there are always things we can't predict.
Right.
How did Graham deal with the idea of, risk?
Well, this is exactly where diversification is so important.
Okay, yeah.
Yeah.
We talked about that before.
Right.
Not putting all your eggs in one basket.
Exactly. Yep. Diversifying helps to reduce the risk that any single investment will go bad.
Okay.
And make sure your portfolio isn't too exposed
Okay.
to any one company or sector.
Okay. Did Graham suggest a certain number
Yeah.
of stocks to hold for good diversification?
He thought for most investors having at least 10 different stocks in a variety of industries
Okay.
was a good starting point.
Okay. That seems manageable.
Yeah.
But how do you actually choose those 10 stocks? Did he give any guidance?
So that's where it gets, a little more involved.
Okay.
Graham has several chapters on stock selection for what he called
Okay.
the enterprising investor.
Okay. So the enterprising investor.
The one who's willing to put in a bit more work
Okay.
to try to get higher returns.
All right. So let's dive into those chapters. What were some of the key takeaways for those who want to be more enterprising?
Yeah. So one big thing he stressed was looking beyond just the current year's earnings.
Okay.
He wanted investors to consider the long-term earnings record of a
Right.
company.
So not just like chasing the latest hot stock or
vibe.
jumping on the bandwagon
Right.
of a company that just had one good year.
Exactly.
Okay.
Intelligent investors need to look past the headlines
Yeah.
and understand how a company has performed
Okay.
over time.
Okay, so like through different,
Right, through different economic cycles,
Yeah.
market conditions.
and I'm guessing, Graham also had some thoughts on how to
Yeah.
read those financial statements.
He did
So
something he's released.
You bet he did. There's a whole chapter
Okay.
called Things to Consider About Per Share Earnings,
Okay.
where he really digs into
Okay.
the potential traps
Yeah.
that can make a company's reported earnings misleading.
Those accounting tricks we talked about.
Yeah, exactly. Yeah.
Yeah.
Some things never change, right?
Yeah.
So Graham warned investors to be wary of things like, special charges,
Okay.
extraordinary items.
And changes in accounting methods
Yeah.
that can make a company's earnings look
Yeah.
better or worse
Yeah.
than they actually are.
So it's like those magicians
Yeah, exactly.
who use,
Sleight of hand
sleight of hand
Right,
to
yeah.
make things appear or disappear.
to make you think they're doing one thing when they're actually doing another.
Yeah,
Yeah.
exactly.
Okay, so companies can do that with their earnings.
They can.
Okay, so we need to be
You got to be skeptical.
skeptical and not just believe those per share earnings numbers at
Not at face value.
face value. Yeah.
Nope.
What else should we watch out for?
So Graham was really concerned about what are called pro forma earnings,
Okay.
which basically exclude certain expenses
Yeah.
to make the numbers look better.
Okay.
And they really are.
So it's kind of like saying here's how much we would have earned if we didn't have to pay for all this stuff.
Yeah, that's a great way to put it. Exactly.
Yeah. It's a way for companies to present this rosier picture
Yeah.
of their profitability.
Okay, so it's like airbrushing a photo to make it look
Yeah.
more flattering.
Exactly. It might look good on the surface,
Right.
but it's not reality.
Right.
So Graham insisted that investors should focus on the real GAAP compliant earnings.
Okay, GAAP. Now that rings a bell.
Yeah.
But remind me what it stands for.
So GAAP stands for Generally Accepted Accounting Principles.
Okay.
They're the standard rules
Okay.
that publicly traded companies in the US
Okay.
have to follow when they're putting together their financial reports.
Okay, so it's basically like the rule book.
Right, the rule book for accounting to try to make sure companies are being consistent and transparent with their numbers.
Okay.
Exactly.
So Graham believed that sticking to those
Sticking to those GAAP earnings
GAAP compliant earnings
is essential
was essential, yeah.
for making sound decision.
It sounds like, Graham was a big advocate for transparency and honesty
Yeah.
in financial reporting.
Absolutely. Yeah, he believed investors have a right to clear, accurate information about the companies that they're considering.
And he wasn't afraid to call out
companies that were trying to hide the truth
Yeah.
with their accounting tricks.
He even dedicated a whole chapter to analyzing what he called
He did dubious practices.
dubious practices. Wow, I can only imagine the shady stuff he uncovered.
It's pretty bad.
What were some of the worst examples?
So he was really critical of companies that manipulated their depreciation charges,
Okay.
used aggressive revenue recognition tactics,
Okay.
and tried to obscure their true financial health with these
Wow.
complicated off-balance sheet transactions.
So those sneaky clauses hidden in a contract that you don't find until it's too late.
Yeah, exactly. Yeah.
Yeah.
Okay. So he wanted to shine a spotlight on these practices
Right.
and give investors the knowledge to kind of protect themselves.
Okay, so we need to be on the lookout for those red flags. But even with the best analysis,
Yeah.
there are always unknowns,
Right.
How did Graham suggest managing risk and uncertainty in general?
Well, that's where his concept of margin of safety comes in.
Ah, yes, that buffer
That
to
buffer.
protect us from
Yeah, Graham knew
the unexpected.
that even with great analysis,
Yeah.
there's always a chance you could be wrong
Right. Yeah.
about a company or that something unexpected could happen.
Right. The best laid plans can still go wrong.
Exactly. So that's why he was adamant about buying stocks
Okay.
at a price that
Right.
was much lower
Okay.
than what he thought they were actually worth.
Okay. So building in that discount
Building in that discount.
to account for
Yeah,
those potential risks.
exactly.
How big of a margin of safety did he recommend?
He usually said to aim for a discount of at least 25% to 50%.
Wow, that's a big cushion.
It is.
I can see how that would help you sleep at night.
Yeah, it does.
Yeah.
Definitely. And remember, the margin of safety isn't just about the price you pay.
Okay.
It also applies to the quality of the business itself.
So investing in companies that have, like a solid track record,
Right.
strong financials,
Wrong finance.
and something that sets them apart from the competition.
Exactly, yeah. Because even if you buy a stock at a price that seems cheap,
Yeah.
if the business itself is weak,
Right.
you could still lose money.
That makes perfect sense.
Yeah.
So you got to be smart about the price you pay and
That's right.
make sure the business itself is solid.
Exactly.
Any other
Yeah.
wisdom that Graham shared on managing risk?
Yeah, he also stressed diversification.
Okay.
So spreading your investments across different companies, right?
Industries
Yeah.
and even different types of assets.
The don't put all your eggs in one basket strategy.
Exactly right. Diversification helps to kind of minimize
Yeah.
the impact if one investment doesn't work out.
Yeah.
And it makes sure that your portfolio isn't too dependent
Yeah.
on any one part of the market.
Now, we talked about, holding at least 10 different
Yeah.
stocks. Did he have any recommendations for when people who are a bit more
More adventurous.
adventurous?
Those enterprising investors we talked about.
Yeah, the enterprising investors.
Yeah, he did. There's a whole chapter
Okay.
dedicated to portfolio policy for the enterprising investor. The positive side, where he
Okay.
explores more aggressive strategies.
All right, so let's hear it. What are some of the key takeaways
Right.
from that chapter for, the people who really want to,
Okay, so he talks about strategies.
investing in relatively unpopular large companies,
Okay.
looking for what he called special situations,
Okay.
things like mergers and acquisitions,
Okay.
and even dabbling in convertible bonds and warrants.
Whoa, now that sounds next level.
It is.
Can you break those down a bit for us?
Yeah, sure. So when he talked about relatively unpopular large companies,
Yeah.
he meant companies
Okay.
that had temporarily fallen out of favor,
Okay.
but still had strong fundamentals.
Okay, so like diamonds in the rough
Exactly.
that are being overlooked?
Yep. Yeah. Graham believed
Okay.
that these companies often presented great opportunities
Okay.
for investors who were patient and willing to wait
Okay.
for the market to recognize their true value.
Okay, I see the potential there. What about
Yeah.
those special situations?
Right. Right.
What did he mean by that?
So he was talking about unique investment opportunities that
Okay.
come up from corporate events, like mergers, acquisitions, restructurings, or even when a company is liquidating its assets.
So trying to find opportunities in those moments of
Yeah, exactly.
change and disruption
Change and disruption.
in the corporate world.
Yeah, that's it.
Okay.
Yeah.
I'm guessing, those special situations
Yeah.
require a lot more
They do.
expertise and
All right.
understanding of how the markets work.
Yes, Graham was very clear that these strategies weren't for beginners
Right.
Yeah.
Okay. That makes sense.
and required, careful analysis and a willingness to take on more risk.
Okay. And what about those convertible bonds and warrants?
Yeah, those can be
Those sound a bit intimidating.
they can be intimidating.
Yeah.
So convertible bonds are basically
Yeah.
bonds or preferred stock that you can convert into regular stock
Okay.
at a set price.
Okay, so you kind of get
Yeah.
the best of both worlds.
Kind of, yeah.
The stability of bond,
Right.
but the potential upside of a stock.
The potential for growth, exactly. And
Yeah.
warrants give the holder the right to buy a certain amount of stock
Yeah.
at a specific price within a certain time frame.
Okay, so it's kind of like having an option
It is, yeah.
to buy the stock later,
Yeah.
hopefully at a
Hopefully at a good price.
good price, yeah.
But Graham warned that both convertible bonds and warrants can be tricky.
Okay.
So you really have to understand the terms and conditions before you invest.
Okay, so tread carefully.
Carefully.
Yeah. Now I know Graham was all about, patience and discipline.
Yeah.
Did he have any specific advice for
Yeah.
developing,
Yeah, he emphasized
taking a long view?
Okay.
Not getting caught up in the day-to-day
Yeah.
ups and downs of the market. Yeah. So tuning out all the noise.
Tune out the noise.
Yeah, and focusing on
Focus on the long-term
the long-term
growth of your investment.
growth of your investments, okay?
Exactly.
Easier said than done sometimes, though.
It can be. Yeah. He also believed that controlling your emotions
Yeah.
and not letting fear or greed, drive your decisions
Yeah.
was crucial.
Yeah. That's a tough one.
It can be tough.
Yeah.
But Graham believed that, if you develop a sound investment philosophy,
Okay.
you stick to your principles,
Yeah.
and you avoid those emotional traps,
Right.
you can be successful
Yeah.
in the market over the long term.
I'm already feeling like, more grounded and confident
That's great.
about investing just from, hearing all of this. But I have to ask,
Yeah.
how relevant
Right.
are Graham's ideas today?
Yeah.
I mean, we've got
Right.
algorithmic trading,
We do.
high frequency trading,
Yep.
the 24/7 news cycle. I mean,
Yeah.
do his principles still hold up in this, modern
Yeah, that's a great question.
financial landscape?
That is a great question.
Yeah.
And it's a perfect lead-in
Wow.
to the final part of our deep dive. But
Yeah.
I think even in today's, crazy fast-paced markets,
Yeah.
Graham's core principles
Yeah.
of value investing remain incredibly relevant.
Okay, awesome.
Yeah.
But before we move on to that,
Yeah.
let's just recap
Right.
what we've covered so far.
Sounds good.
So we started by looking at bond funds.
Yep.
And how they can be this, useful tool,
Useful tool, especially when those interest rates are high.
especially when interest rates are high.
Mm-hmm.
Okay. And we walked through, Graham's analysis
Right.
of those 4 real companies,
Real companies
showing how to,
showing how to go beyond the hype.
go beyond the hype and really figure out a company's
A company's real value.
real value. Yeah.
Yep.
Then we talked about, Mr. Market's folly
Mr. Market's folly.
and how
How those smart investors can actually profit.
profit from it,
Yeah.
from those irrational price swings.
Yeah, exactly.
We also talked about those sneaky per share earnings traps.
Yeah. We did like pro forma.
Pro forma earnings
Yeah.
that can, distort the company's true financial picture.
Yeah, for sure.
And of course, the all important
Yeah.
margin of safety.
Origin of safety.
Buying stocks at a good discount to protect yourself from,
Protect yourself.
risks.
Yeah.
And we even got a taste of, some of those
Right.
more adventurous
Adventurous.
strategies for those enterprising investors.
Enterprising investors,
Yeah.
things like,
Things like those unpopular large company. Yeah. Yeah. The unpopular large companies.
yeah,
And those special situations.
financial situations.
And to top it off, we talked about, the importance of patience,
Situations.
discipline,
Dis-
and keeping those emotions
Yeah,
in check when you're
when you're investing.
investing.
Absolutely.
Ooh, that was a lot.
It was a lot.
It was a great discussion, but
Yeah.
there's still so much more
There's still so much more.
to uncover
Yeah.
in the intelligent investor.
And the intelligent investor.
So stay tuned, everyone.
Great, dude.
Final part
Yeah.
of our deep dive.
Of our deep dive.
We'll see how Graham's teachings can
Right.
help you,
Navigate today's markets.
navigate today's markets and
We're
build
ready to go.
a truly, robust
Yeah.
portfolio that can
Withstand the test of time.
stand the test of time.
That's it.
All right, so we're back for the final part of our deep dive into the intelligent investor. We've, covered a lot of ground, those, core principles, some of the, more advanced strategies, but now I'm really curious, how does all of this connect to the world we live in today?
Right.
Like, how can Graham's wisdom help us, navigate today's, complex,
It's so good.
financial markets?
It really is. Yeah. I think one of the biggest challenges for investors today is just the sheer amount of information
Yeah.
we're bombarded with
Yeah.
every day.
Every day.
It's so easy to get overwhelmed and lose sight of those timeless principles we've been discussing.
Yeah, it feels like there's a new
Whoa.
hot tip or market prediction
Yeah.
every time you turn around.
Everywhere you look, exactly. And that's where Graham's emphasis on,
Yeah.
independent thinking
Yeah.
and focusing on the fundamentals, I think
Yeah.
is more important than ever. Because, he always reminded people
Yeah.
that the market isn't always rational.
Yeah.
And prices can go haywire
Yeah.
based on emotions and speculation, not the true value of things.
Right. We can't forget about, Mr. Market
Right, Mr. Market.
and his unpredictable moods.
And his moods.
Yeah.
Right. He was a great analogy for that.
We're what?
Graham really wanted investors to,
Yeah.
separate themselves from those emotional swings
Yeah.
and stay focused on
Yeah.
what a business is actually worth.
So, like, how do we, practically do that? Like,
Yeah.
tune out the noise and, find the signal
Yeah.
when everyone is.
Yeah, when everyone's shouting their opinions,
Yeah.
their predictions these days.
Yeah, exactly.
Yeah, Graham, he believed that having a sound investment philosophy,
Okay.
like one built on strong principles
Yeah.
and a real understanding of business, was key.
Yeah.
It's like having that internal compass.
I like that
Did not-
nocturnal compass.
It guides you
Yeah.
through the market's ups and downs.
Okay, so what are some of, like, the key points on that internal compass?
Right. Yeah. So it should be grounded
Yeah.
in things like, a company's long-term earnings,
Yeah.
how strong its financial position is,
Okay.
the quality of its management team,
Yeah.
and whether it has, a real competitive edge in the market. Like
Yeah.
these are the things that ultimately
Yeah.
determine a company's real worth,
Okay.
regardless of how Mr. Market
Right.
might be feeling on any given day.
So we need to, like, look beyond the hype
Absolutely.
and the headlines.
The headline
and focus on those
Yeah.
core drivers
of value.
of value. But I know, like, Graham also cautioned against,
Yes, he did.
relying solely on, like,
On numbers and spreadsheets.
yeah.
Numbers are important, but they don't tell the whole story.
Okay.
He's a big believer in
Yeah.
considering qualitative factors too.
Okay, like what kind of qualitative factors?
So things like
Yeah.
the quality of the company's leaders,
Okay.
the strength of their brand,
Okay.
the relationships they have with their customers, their suppliers, and their ability to like innovate and adapt
Okay.
as the world changes.
It sounds like it's not just about, crunching the numbers,
Right.
but about understanding the nuances,
The nuances
of the
of
business,
of the business.
where it fits in the competitive landscape.
Exactly. Yep. It takes, this more holistic view, combining both
Yeah.
the hard numbers and those more qualitative assessments.
That makes a lot of sense.
Yeah.
Now, Graham mainly wrote for
Yeah.
individual investors.
Yeah.
But do you think, like, his teachings are also relevant for
Oh, yeah.
like
Abstract.
the pros?
Yeah. Yeah.
The people managing, like,
The big investment funds.
yeah, the big funds. Yeah.
Oh, absolutely. Yeah. In fact, like a lot of the most successful investors today,
Yep.
people like Warren Buffett, Seth Klarman,
Okay.
Charlie Munger,
Yeah.
they all point to Graham as this like huge influence on their approach to investing.
Wow, that says a lot about the staying power
It does.
of his ideas.
It really does.
But I have to ask,
yeah.
given, like, all the advances in technology and
Right.
how complex the markets have become,
Right.
are there like, parts of Graham's teachings that need to be,
That's a great question.
like, adapted or updated for today's investors?
Yeah. That's a great question. And it's one that people have been debating for years.
Okay.
Some people think his methods are outdated
Yeah.
in this, fast-paced world.
Okay.
While others believe that his core principles are timeless.
Okay.
There isn't like a
Okay.
simple answer.
So there are, like, valid
Yeah, there are valid points.
points to be made
Be made on both sides.
on both sides.
Yeah. It's important to remember that Graham was writing at a time when, like, information was harder to come by
Yeah.
and trading was
Right.
much more expensive.
Yeah.
Things have changed
Yeah, it's a big difference.
a lot since then.
Yeah.
Right. So some people argue that,
Yeah.
rise of index funds, the fact that markets are, more efficient than they used to be, and the availability of these, sophisticated computer programs have made Graham's approach less effective.
But I imagine there are also, like,
Oh, there are.
strong counterpoints
Oh, yeah, absolutely.
to those arguments.
Yeah, for one thing,
Yeah.
markets aren't always perfectly efficient.
Okay.
Look at the dot-com bubble,
Right.
the housing crisis.
Yeah.
Those were like, perfect examples of
Yeah.
Mr. Market getting carried away
Yeah.
and prices becoming completely detached from reality.
Those were definitely times when emotions were driving.
Emotions were driving things.
Yeah, driving the markets.
For sure.
Yeah.
Yeah. So,
Okay.
and even, in a more efficient market,
Okay.
I think there's still opportunities
Yeah.
to find
Okay, great.
undervalued assets.
Okay.
You just have to be willing to go beyond those
Oh, yeah.
popular stocks and do some
Yeah.
real digging.
So it's almost like panning for gold.
Exactly.
You got to sift through
You got to sift through a lot of dirt
a lot of dirt to find
to find those valuable nuggets.
those nuggets.
Yeah, that's a great way to put it.
Okay. Yeah.
Yeah, and Graham's teachings
Yeah.
give you like the tools and the mindset
Okay.
to be successful
To be successful in that search.
in that search. Yeah.
Okay, you've convinced me. Graham's wisdom
Yeah.
is definitely still relevant.
It's timeless.
But I'll be honest, like putting all this into practice
Yeah.
can feel a little
Oh, sure not.
overwhelming, especially for someone who's, like new to investing.
Right.
What advice would you give to,
Yeah.
people who are like, feeling a little intimidated?
Yeah, I think the most important thing is to start by getting like a solid grasp
Okay.
of the basics.
Okay.
Read The Intelligent Investor
Yeah.
carefully.
Yeah.
Don't rush it. Take the time
Yeah.
to really understand.
The concepts.
Yeah.
It's a book.
Yeah, it's not a quick read.
No,
it's full of these insights that you really
You got to let them sink in.
need to take time to consider.
Exactly. And don't be afraid to reread
Yeah.
certain chapters or sections that
Yeah.
feel particularly relevant
Okay.
to your situation.
And I'm sure there are, also lots of
Oh yeah.
resources, online and elsewhere
There are tons.
to kind of,
Yeah.
help people,
Right.
understand and apply Graham's teachings.
Absolutely. Yeah. I mean, there are tons of books,
Yeah.
articles, websites, even podcasts
Right.
out there
Yeah.
dedicated to
Yeah.
value investing and,
Yeah.
and Graham's principles.
So it's like a whole community of intelligent investors out there kind of, carrying on his legacy.
Legacy.
And learning from each other.
Yeah. Learning from each other.
Yeah. That's great.
Yeah.
Well, I think that's a great way to wrap up our deep dive
Yeah.
into Intelligent Investor. So
Yeah.
thank you so much for joining me today and
It's been my pleasure.
sharing your expertise.
I've really enjoyed it.
Yeah, and just to leave everyone with one of my favorite Graham quotes.
Oh, okay. Yeah.
He said, "Investing is most intelligent
Oh,
when it is most businesslike."
wow.
Yeah,
So let's all strive to be those, intelligent,
right.
business-like investors making, well-informed decisions.
That's it.
Grounded in solid principles and a long-term perspective.
You got it.
All right. And to our listeners, thanks for diving deep with us.
Yeah, thanks for joining us.
We hope you found this insightful
Yeah, I will.
and empowering.
Yeah.
Remember, the journey to becoming
Yeah.
an intelligent investor is
A marathon,
a marathon, not
not a sprint.
a sprint.
That's right.
So keep learning,
Keep learning.
keep exploring, and keep growing. Keep
exploring.
your financial knowledge.
Financial knowledge, yeah.
Absolutely.
Until next time, happy investing.
Happy investing, everyone.